You tap your card. The machine beeps. The cashier hands you the coffee. It feels as though money just moved from you to the cafe. It didn't. What moved first was a request, and that request is about to make a surprisingly long journey. The card reader begins by assembling a small packet of information: the purchase amount, the merchant accepting the payment, and the credentials needed to identify the card or its digital substitute. If you tapped a phone or wallet, the merchant may receive a token instead of the card number itself. The terminal does not decide whether you can buy the coffee. It prepares the question. That question is protected and sent away from the store. It may pass through a payment gateway or processor, the machinery that carries transaction information between the merchant and the financial institutions behind the card. This all happens before the receipt begins to print. The request first reaches the merchant's side of the payment system. The company or bank handling payments for the cafe is called the acquirer. Its job is not to lend you money. Its job is to accept the merchant's request and send it into the card network. The network reads the card information and works out where the request belongs. A card network connects the merchant's side of the transaction with the institution that issued your card. The request is routed toward your issuer, the bank or financial institution responsible for your account. Now the real decision begins. The issuer checks whether the card is valid and whether the account is open, active, or restricted. A card reported lost, frozen in an app, or blocked for another reason may stop here. The issuer also examines risk signals. Does this purchase resemble the cardholder's normal behavior? Is the location unusual? Has the same card suddenly appeared in two distant places? Does the transaction carry the security information expected from this type of payment? No single question decides everything. Many small signals contribute to a fast risk decision. Then comes the obvious question: is there enough available credit or, for a debit card, enough available money to cover the request? The issuer is still not sending funds to the cafe. It is deciding whether to reserve room for the purchase. If the checks pass, the issuer returns an approval and usually places a hold against the available balance or credit. If they do not, it returns a decline. That tiny answer is what the store has been waiting for. The response travels back along almost the same route, from the issuer, through the card network, through the merchant's processor or acquirer, and finally back to the terminal. The entire round trip commonly finishes within seconds. The terminal receives the answer: approved. That is the moment you hear the beep. But the beep does not mean the cafe has your money. It means the cafe has permission to complete the sale. Authorization and payment are not the same event. The coffee can now be handed over. The receipt can print. You can walk away. From your point of view, the purchase is finished. Behind the counter, it has only reached the end of its first act. The authorized transaction waits to be captured and settled. Some merchants capture it immediately. Others collect authorized sales and submit them later. Hotels, rental companies, and fuel stations may wait because the final amount can change. The approval is temporary. The completed charge still has to be presented. Traditionally, a merchant gathers the day's completed card sales into a batch. Instead of treating each cup of coffee as an isolated banking event, the payment system can process many transactions together. The merchant sends the completed sales to its processor or acquiring bank. Now the transaction begins its second journey. The payment information returns through the card network, not to ask permission this time, but to clear the records and calculate what each institution owes. This stage is called clearing. The network delivers transaction details so the issuer and acquirer can record the same completed purchase. It also helps calculate the amounts owed between the institutions participating in the payment. Clearing moves information. Settlement moves value. During settlement, funds move between the institutions on the cardholder's side and the merchant's side. This usually does not happen as a tiny individual coin traveling directly from your account to the cafe. Large payment systems can total many obligations and settle the resulting amounts between institutions. The merchant is then funded according to its agreement with its payment provider. The deposit may be smaller than the original sale because processing costs and other agreed fees can be deducted, and it may arrive a day or several days after the customer finished the coffee. Finally, the cafe matches the deposited funds with the sales recorded by its register. If the totals do not agree, someone has to find out why: a refund, a reversal, a fee, a missing transaction, or a settlement arriving on a different day. This is reconciliation, the quiet accounting work that closes the loop. So the next time a card reader beeps, remember what it actually means. In a few seconds, a request traveled from a store to a processor, across a network, to the institution that issued the card, and all the way back. Then, after you left, the transaction began another journey through capture, clearing, settlement, funding, and reconciliation. One tap, two journeys, and the money arrived long after the beep,